think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show. Hey, I hope y'all doing good today. I'm in a good mood, so I hope that y'all in a good mood as you turn on this video so we can get into some financial topics, especially when we're looking at the macro picture, the fundamentals of how it affects our money, our investments, our freedom, our finances, all those things. So let's go ahead and jump in it today. So the market had a bloody week. I believe there's articles coming out saying that this is the fifth week in a row where the markets have been just tanking. And we know that the Fed came out and raised interest rates, the federal funds rate, and we know that they are talking about tightening, selling bonds off their balance sheet because the Fed's balance sheet is ballooned, hyper ballooned. And so we're going to look into all of that. And I really just want to dive into how is this affecting the markets? And what can we do to protect our money, protect our wealth, protect our investments? So let's go ahead and dive a little deeper into this. So first thing is that when the Fed raises interest rates, we know that the 10-year yield tends to rise. We know that the growth stocks tend to get hammered. And this is because there's a lot of corporate debt in growth stocks. They buy a lot of other companies. They invest more. They're not really free cash flow producing as much as the value sector. So the value sector would be stocks like oil stocks, would be a value sector stock where they actually produce a lot of income and they just consistent, and they're not as risky with their investments versus a growth stock would be a company that's going out to acquire another company and they're doing a lot of things so that they can grow really fast. And they may not be as income producing as a value stock. And so when the Fed is raising interest rates, the corporate debt, the debt that the growth stocks acquire whenever they are doing all of these different moves tends to go up. It's more expensive for them to borrow. And then it also affects their income. I mean, especially when you look at whether you want to buy gas, whether you want to buy food, or whether you want to keep your Netflix subscription. Now, those are some things to think about. So a lot of these growth stocks, especially tech stocks, they tend to get hammered when the Fed starts raising interest rates because it's an environment that is challenging for them. So let's go ahead and dive into this. So we're looking at the Fed's federal funds rate and how they raise interest rates. We can look back in the 80s when Volcker was in. The interest rates, he let them get up 17%. They got up to 19% right there. They got up to 19% again. So he let the market set the interest rates. And this was important to fight off inflation because inflation was pretty high in the 70s. And they tried to raise interest rates before and they ended up, I forgot what exactly happened, but they tried to raise them and then, they came back down, 4% or whatnot. This is the federal funds rate. And then they ended up skyrocketing when Volcker got in because he was just like, hey, I got to get inflation under control. We have to get inflation under control. And granted, back then, we did not have as much debt. We were not in as much debt as we are now. I mean, right now we have 30 trillion in debt and we have 130 trillion in off-balance sheet liabilities. Those are promises to pay Social Security, Medicare, pension benefits, and all those things. So that's off-balance sheet. But on-balance sheet, we have about 30 trillion. So when you're looking at this, I mean, look at just even in the 2019. This is when Jerome Powell wanted to start tightening. So they started inching up the interest rates. He wanted to start tightening and raising interest rates. And then you had, the COVID came and pretty much that plummeted. They had to lower interest rates. They had to start buying bonds again. And look at this. Look at how much, I mean, we're in May now. They did another, 50-point basis hike. So we're still far off from where we were back in the 80s. We're way off. And these stocks are just selling off drastically for this little tiny increase, this little blip on the chart. So let's go ahead and zoom into that. So, looking at this, this is a little blip on the chart. Like, it's not even really that relevant. I mean, and even when you zoom in, like they haven't increased it a whole lot, and the markets are so spooked, and these stocks are like just plummeting. These growth stocks are plummeting. So we're going to look at more of that. So one other thing to realize is that there's always a rotation between growth and value stocks. We've always been in the period of growth stocks. I mean, they've always outperformed value. If you're looking at the long-term charts, but there's times where value stocks outperform growth, and it goes for a period of time. So, for example, you can see, early on, this chart goes back to 1978, I think, something like that. You can see that, the growth stocks were outperforming. So this is like the growth to value ratio, 1.134 or whatever in the 90s. Then you see the .com bubble, where growth to value stocks were at the ratio was 1.694. So the growth stocks were highly overvalued, and it even says it right there, .com bubble, right? That was the top of that. So then growth begins to outperform value stocks. So after the .com bubble popped, the value stocks began to outperform. So then the growth to value ratio drops significantly. So you can see, where it goes from there to here. This is when the growth stocks started to outperform, and they outperformed for a while. As you can see, you had a lot of emerging markets. That was a place where a lot of people were investing at that time. So emerging market stocks started going up, and then you had the global financial crisis. So stocks began to, the growth to value ratio began to climb up a little bit, as you can see, and then you get this dip right here. This is the housing crash around this time. And then you begin to see that the growth stocks start to go back up again. I mean, you had another little dip. I believe that was around the global financial crisis or whatnot. And this is just a ratio. I mean, it's just a macro picture of it. It's not specific. I mean, obviously some stocks went down farther than this little dip or whatever, but this is just a macro picture with just using a Wilshire growth to value ratio chart. And then, the Fed started quantitative easing. I mean, especially since the crash in 2008, the Fed started pumping money into the system and started buying bonds and stuff and lowering interest rates. And you can see that the growth to value ratio started climbing. And so we've been in this long bull market of growth stocks outperforming value stocks. Also during this time was the commodities boom. You had uranium that was booming. You had oil that was booming. And I believe oil topped in around 2010, 11-ish. And then they began to decline. So like when you're looking at this, you had a lot of different factors. Value was outperforming growth. Commodities were booming. I mean, you had gold, stocks going up. You had uranium, oil, all these natural resources stocks, emerging markets, all those things were outperforming. And then you had growth just go on a long run. I mean, if you think about it, these stocks been running for a long time. I remember in 2017, when I first got into the market, I was buying some growth names. And then I would look like 2 years later, I'm like, man, that stock grew that much. I was like, dang, why didn't I just hold on to that stock then? And so I didn't know what was going on in the macro picture. Now I understand. So we saw that, in November 2021, these growth stocks topped out. And now they've been on the decline, especially since the Fed has been tightening and coming out more hawkish. So now the growth to value ratio, it has overturned, and we believe that it's going to go even further. I don't know how long it's going to last or whatnot, but we're going to look at some specific stocks. So this specific stock right here is Shopify. Right. So Shopify, I remember hearing about Shopify in 2017. I believe Shopify was at that time about $150. I was buying Shopify. I believe it was 2017, maybe it was 2019 or something, but it was at $100. This stock was at $150, I remember. And then when you look at, just the growth of it, I mean, look at the growth. It grew from, $100 and something to $1,700 and something. And this is crazy, so it grew that high, and this was in November of 2021. I mean, and then we look at the growth to value ratio, back over here, November 2021, you see. So then you see Shopify top out, and then it just went on a huge decline since then. So now Shopify is at about $370 something. Let me figure out, why is this chart not showing? Oh, there it go. I was supposed to click and drag it up, y'all. My bad. That was a rookie move. It hit 350 something. I think I averaged in at 359, and I was kind of like really hesitant about averaging in on this because I think that these growth to value ratio kind of things, these cycles where growth and value outperform each other, last longer than a few months. I mean, this just topped out in November. This probably has longer, further down to go. But I mean, looking at from the top 1,700 to 355, I mean, I just think that it was extremely cheap. I mean, regardless if I bought it at, $350 or $400, I mean, it's way cheaper than $1,700. Somebody probably got in November, like, oh, Shopify is a good stock, let me get in here, and lost a lot of money. And so I got it way cheaper. But obviously it could go down further because the Fed is not talking about easing yet. At some point they're going to have to ease because you have these politicians that are, they want to spend money. They got these things they're lobbying for. They have things that they want to get done and things that they're pitching to the people. But, the Fed has to reverse course at some point. And then also the interest that the government has to pay on their debt, it will get extreme if the Fed continues to raise rates and could risk a default. And so, you don't want your government defaulting on their currency. You better own gold in that situation. And that's what I just think that, it's not going to reverse course anytime soon. So this stock could go down, a little more, maybe to $200 or something. I don't know. But I think that, averaging in and being kind of careful and just managing how much you're averaging in is very important. And also another thing is that, looking at dollar cost averaging. So like using stock platforms like M1 Finance and such, those are very helpful. All right, so here we go. This is where I was in. I was in Shopify back in, it's like 2018, 2017. So this was at $150 then. That's when I was in it originally. So, and right now it's at 350. Went up to 1,700. Now it's at 350. So let's just look at some other growth names. I mean, I showed y'all Netflix. I think I showed y'all Netflix. Let's look at Netflix again. All right, so Netflix is currently at 175. This is another growth stock company, and yeah, they're currently at 175. I remember when Netflix was at about $150 back in 2017. So these stocks are back to like where they were, prior to the run-ups. I mean, some of them back to their COVID lows or whatnot when we had that big liquidity shock. But if you look at like the I'm trying to zoom out of this thing. This thing is just this chart is kind of annoying. But when you look at November of 2021, you just begin to see like, okay, Netflix topped out $700. $700. Now it's at 180. Hit 175. Now it's at 180. So is that a good value company? I think maybe, but one of the things that you have to think about is that there is a lot of competition. There's competition in everything, but when I invest in value stocks, I think of like the tobacco industry. Like there's no more tobacco companies that can be created because of rules made by Congress and such. And so those are some of the things I think about. And versus like Netflix, anybody can come into that space. Disney's coming into that space. You got Roku, you got all these other competition, And so I just think that the growth stocks have, probably some more down ways to go. You don't want to fight the Fed. That's what everybody said. Oh, the Fed put. When the Fed was printing money, buying bonds, you could have been in these growth stocks and experienced some huge run-ups. Now the Fed's tightening and raising interest rates. So now you don't want to fight the Fed, because if you fight the Fed, you will lose out. I mean, unless you're a trader that you can trade these little bounces here and there, I wouldn't risk it. I wouldn't risk fighting the Fed. Unless you're averaging in, dollar cost averaging. So I hope this was helpful for you all. Be sure to hit the like, the subscribe, drop a comment. What are some things that you're looking at? What value stocks are you into? What growth stocks are you looking at? Drop some tickers down below. I'd love to look at what you guys are looking at as well. So I want to thank you all for joining the Money Level Show, and y'all have a blessed day. Peace.